Hi, and welcome to Barnes Dennig Ask the Experts. I'm Kat Jenkins, Marketing Director, and today Chad Kolde and Beth Raines from our manufacturing practice team are joining us to talk about depreciation and GAAP. Chad and Beth, welcome.
Thanks, Kat. Thanks for that introduction, Kat. 2020 has certainly been an interesting year, a lot going on in this calendar year. And Beth, you're the tax expert amongst us. Has this had any impact on tax depreciation from a tax perspective?
Yeah, Chad, it absolutely has. So we've seen a lot of recent tax law changes as it relates to long-lived assets. So essentially, those assets that are required to be depreciated and expensed over, what we would say is their useful life. So, some of the somewhat recent ones, and, this then kind of leads into 2020 changes, is the Tax Cuts and Jobs Act introduced the concept of 100% bonus depreciation. So this allows a taxpayer to take as a deduction in the year they place an asset in service, the full cost of that long-lived asset. So importantly, under the TCJA, there was this concept of qualified improvement property that came into play. So this is property that essentially, under previous years, would have been capitalized as part of a building and depreciated over a longer lifespan. So that would be roughly, say, 39 years. But then TCJA, with this qualified improvement property, shortened that to about a 15-year life. However, the TCJA did not clarify, can this qualified improvement property be expensed using those bonus provisions? So along comes 2020, the CARES Act clarified that indeed you can use 100% bonus for that qualified improvement property. And as expensive as it is to make, certain improvements to a building that would be primarily interior improvements, that can cost a lot of money. And so this can have a really significant benefit for a lot of taxpayers. So I'll say that, if you've been looking to make significant improvements and holding off, it would likely be worth looking at doing so. However, qualified improvement property, there's a lot of nuances to what is and is not. There's a lot of things that are still getting pulled into the cost of the building from a tax perspective. And so it's really important for taxpayers to work with their tax advisors to understand how these improvements they're making would be treated from a tax perspective. So this qualified improvement property, this is really a tax concept and it encompasses improvements such as, say, leasehold improvements. So, Chad, is there any potential reporting pitfalls that practitioners and preparers should be aware of as it relates to depreciation under GAAP for some of these items that could fall into qualified improvement property?
Yeah, that's a good question, Beth. There are several pitfalls that we typically see as it relates to just depreciation and long-lived assets in general as financial statement reviewers and auditors. One being, whether repair and maintenance should be capitalized into fixed assets or whether it should just be expensed to the income statement, whether or not an asset should be capitalized in the first place or if it just meets some de minimis threshold where we feel comfortable expensing it all together. But a lesser known one, but an issue nonetheless, is the leasehold improvement capitalization policies. Typically, we see companies or prospects capitalize these over 15 years. It just seems to be the default for a lot of these fixed asset softwares. But the GAAP, or generally accepted accounting principles, or GAAP as we call it in the biz, requires that you capitalize that over the remaining lease term. So, you just touched base on some of these leasehold improvements from an office standpoint. So if you're a company and you lease out your main office space and you go through some major office renovation, maybe pre-COVID, you're required to capitalize those over the remaining lease term. So if the remaining lease is for 3 years, and you capitalize those over 3 years and not the 15 that we ordinarily see. The theory is that at the end of that lease term, you will legally turn over that office space to the lessor. So that lease term represents, your legal right to those assets, and not the 15 years. So the practical standpoint, from a practical matter, is that you're going to have higher depreciation expense than you otherwise would have had originally. So that's a potential negative impact, but nonetheless one that GAAP requires. There are other significant changes coming down the pipeline as it relates to leases. One being in 2022, companies are going to be required to capitalize most leases onto the balance sheet. And if there's one thing I've ever learned in this industry, it's that GAAP never looks the same way at things as federal tax does, right? So is it possible that these changes under GAAP could impact tax depreciation?
So you hit the nail on the head that, yeah, definitely tax and GAAP can be very different. And sometimes I think they're getting more and more different as we go. So generally, if you have a change in depreciation on the GAAP side, that method doesn't necessarily trickle down to tax. So in the sense that, tax methods are dictated by tax legislation. So, these GAAP changes you mentioned don't really have an impact on the tax treatment. However, as people are working through examining this for GAAP purposes, they're going to be pulling information on, perhaps like new additions or new leases and, perhaps, some prior treatment. So this increased review on the book side could be a great opportunity for tax practitioners to revisit how they've been depreciating this stuff from a tax perspective. So they can take advantage of this information that's readily available and see, is there a better method I could use going forward? And is there the opportunity to adjust previous methods by filing a method change and potentially recognizing additional depreciation expense in that current tax year? So, but, as part of that, as I had mentioned previously, that, there is more of a growing difference between, treatment on the books as well as tax treatment for the same asset. So for corporate taxpayers, this has an impact on deferred tax accounting and is, definitely something that will require additional analysis as these changes are enacted. So, Chad, we have talked a lot about, at least like 2020 from a tax perspective. We talked about some of the changes on like the lease side. Have you seen any other notable impacts on GAAP depreciation that 2020 has brought for us?
Yeah, absolutely. It wouldn't be news to you or anyone listening to this video or watching this video that COVID has had an impact on the local economy, the national economy, the global economy. It's touched nearly every single industry. I really can't think of many industries that haven't been impacted. Some have been impacted very positively from a financial perspective. Others have been impacted pretty negatively from a financial perspective. And this parlays into GAAP, and that GAAP requires you to look at your fixed assets for impairment based on a triggering event, meaning I need to look at the value of my fixed assets that are on my book and whether or not there has been some sort of change in the industry, a triggering event that makes me think that my value of my fixed assets is no longer fairly stated and needs to be written down to some lower amount. A triggering event that would lead you to go through this analysis would be if there's a significant adverse change in legal factors or the business climate that could affect the value of your fixed assets. So if you think of some of the mandatory shutdowns or purposeful business shutdowns that our companies went through, some of our clients went through, that's a triggering event for you to take a step back and say, are my fixed assets negatively impacted now because of this? That doesn't necessarily mean that you're going to have an impairment expense, right? It doesn't mean you're going to write down your fixed assets. But what it does mean is you need to go through that analysis, and the potential for an impairment expense becomes lesser to the extent that the cost of your value of your fixed assets on your books is at a lower amount, right? So if we have higher depreciation, that's going to reduce the cost of our value of our fixed assets and thereby kind of impact or mitigate some of the risk of that impairment loss. So that's probably the biggest change I see in terms of 2020 and how COVID has impacted depreciation expense. Now, you mentioned earlier, the idea of accelerating some expenses for tax purposes through depreciation and leasehold improvements and the like. I would imagine, though, that some businesses will be reporting lower net income and lower taxable income as a result for 2020, given the economic environment we're in right now. Does it still make sense, given that, for some of our taxpayers to accelerate these costs?
Yeah, that's a really interesting question. So in some cases, it could make sense. So as part of the CARES Act, they brought back the ability to carry back net operating losses to 5 previous taxable years, or to the 5 earliest tax year. So as part of that, if you have a loss, say in 2019 or 2020, but you were profitable in years prior, you could carry that NOL back 5 previous years, so net NOL be net operating loss, and realize the benefit of that loss more immediately by receiving a tax refund from that year that you were profitable. So, this can have a number of benefits from a cash flow perspective. But then also we've recently seen, tax rate decreases, in current years. So, notably being the corporate tax rate going down to 21%. So when you carry that loss back to, potentially 5 years ago, you could also see a benefit in terms of that could have been a year with a higher tax rate. So you effectively receive more benefit for that loss. So you create kind of I would say like a permanent benefit for carrying back that net operating loss. So the other interesting angle on this, so in some cases it could make sense to still accelerate costs, especially if you do have good carryback opportunities. However, we've seen changes in political climate. There could potentially be tax rate increases in the future. And so when you look at it from that perspective, it may be better to accelerate income into 2020, a year that we know what the tax rates are, and defer expenses to years that could have higher tax rates. So this kind of creates a lot of interesting factors at play. And it's, really important for taxpayers now to work closely with their tax advisors, understand what is their current tax situation, what options do they have, and, just go forward from there.
So what you're saying is there's no clear-cut answer in 2020, right?
Exactly. So it's definitely been an interesting year for all of us. But we've talked a lot about GAAP and tax, but what about, is there, any insights that would be helpful to know from a non-GAAP perspective?
Yeah, definitely. When we think about non-GAAP metrics that relate to or involve depreciation, EBITDA is the one that comes to mind. EBITDA standing for earnings before your interest expense, tax expense, depreciation, and amortization expense. So we see this a lot in our client base. It might be buried in a debt covenant whereby the company is required by the lender to maintain EBITDA of a certain dollar amount, or it could be tied to an employee bonus program whereby the CFO or controller or some key executive is comped based off of EBITDA over certain dollar amounts. And so obviously depreciation is a variable in that equation. It's an add back to EBITDA. So if I have a larger depreciation expense in my books, it's going to be a larger add back to EBITDA. So depreciation is controlled for, but what's important to note in this calculation is that you have multiple parties relying on this metric. It's not defined by GAAP, so it can be defined 1,000 different ways, and we see it in practice pretty frequently that it's defined differently amongst our client base. So it's important that all the parties relying on this metric know what goes into the metric, know how depreciation and amortization expense affect that metric, and so that they can make business decisions in an informed manner.
Fantastic. Chad, Beth, thank you so much. Some great information there for manufacturers and for other industries as well, I'm sure. Thanks for joining us today. And if you'd like to learn more or would like to set up a conversation, visit barnesdennig.com, and we'll see you next time on Ask the Experts.